I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thanks so much for being here online with me today.
It's my pleasure.
Thank you. So let's jump right into our questions. I think gold is a good place to start today. We saw gold this week move past the 2,000 per ounce milestone. Many people are excited about that. I wanted to ask your thoughts on what you make of gold's price increase, because I think it's not what people were expecting, or at least most people were expecting at the beginning of this year.
Yeah, we were saying that we thought the price could get up to $1,920. August, July, August, September, and obviously we took a lot of probation at that. People were laughing at us, but now they're saying, oh, what did you know? You were clearly underestimating the power. I think you have to look at what's been going on. And first off, for about 12 months, starting last June in 2019, you had a lot of short-term investors coming into the futures market, options, forwards, and ETFs, especially the leveraged ETFs that don't involve physical gold and silver. And so you started seeing a lot of shorter-term investors who were more momentum traders moving into gold and silver. And we were saying at the beginning of this year, you had any number of investors who were saying, well, gold, when's gold price going to rise? It's already risen. By that time, it was already, $1,600, $1,700. And we were saying, gold's at record prices. And on a quarterly average and an annual average, we're going to be at record prices this year. And we might actually get to the spot intraday price, which we have since then. But we were calling it the stealth gold bull market. And that continued until the pandemic hit. And then the pandemic changes everything. And the pandemic changes everything, but the economic lockdown that's a response to it changes everything even more importantly. But right now, what you're seeing is perhaps a combination of three factors. The first thing is this tremendous amount of money that has been poured into the global economy, much of it in U.S. dollars, because the U.S. dollar is 75% of private wealth, 62% of government, central bank reserve, foreign exchange reserves. You've seen this incredible increase in money. And that money isn't necessarily going into the real economy. A lot of it is backed up, a couple $1 trillion, in bank deposits. And so the banks are saying, where do we put this money? And where they've been putting it is in the stock market. The stock market and the NASDAQ is at record highs. The S&P isn't, and Dow Jones aren't, but they're pretty high. And so now there's a great deal of nervousness. Well, we've been parking this money in stocks, but the stocks are vulnerable because there's this gigantic disconnect between a global recession, which is still going on, and very high stock prices. So where else are we going to put money? And one of the places was gold. And then after you filled up the gold coffers, okay, now we're going to turn our attention to silver. So the first thing is a lot of money. Second thing is a lot of banks and institutional investors trying to figure out where to park their money. And then the third thing is the gold and silver contracts on the COMEX themselves and this influx of short-term money into these markets. So, we've blown right past where people thought the prices would go. We thought, gold could get up to 1920. Well, now it's $2,075. And I think that reflects that. Also, you do have, you have 682 million ounces of open interest in the September COMEX contract. That's going to have to be bought back and rolled forward over the course of August. We had 39 million ounces of gold open interest in the August contract at the beginning of July, all of which are all but 1.4 million ounces of which was bought back and rolled forward into the December contract over the course of July. So a big chunk of the upward pressure in gold prices during July was short covering, buying back the shorts in the August contract. And now you're seeing that continue with the September silver contract, and the two move kind of hand in glove. So I think you've got those combination of factors. A lot of money, a lot of people worried about where they're going to put their money, and tight mechanics in the gold and silver markets contributing to these high prices.
So we are past where you at first anticipated gold to get to this year. Do you have an updated idea of where it could go at this point?
Well, you know, if you looked at our 10-year projections for gold prices at any point over the last 3-4 years, we've been saying that we thought that the price could get up to 1,800 or so this year on an annual average basis, which means, you know, $1,800 and $1,900 that you could trade at for a substantial part of this year. And that then the price would kind of plateau, and then it would move higher to about 2,300 on an annual average basis, but probably not until 2023, 2024. In other words, the next election cycle in the United States. So we thought that there were all these economic and political problems, but we thought they wouldn't come home to roost this fast. Now, one of the things that we're wrestling with intellectually among ourselves is are we still in the foothills as we anticipated ourselves being in, or are we much closer to the mountains now? So is this the move to 2,300 or not? And I'd like to believe from a position of, you know, political and social stability that we're still in the foothills. But we may be much closer to that much more significant economic and political deluge than we thought we would. So I think that, you know, I'm hesitant, you know, when our clients put a gun to our heads, we say, we wouldn't be surprised to see this spike take gold to $2,150 before it comes off some. But I think given the economic circumstances, given the political impasse with the second stabilization program in the Congress, given all of the political problems in the United States, and the fact that Brexit is still on the horizon and hasn't been discussed between the Brits and the EU because of the pandemic, I think that things are much more hostile than we thought they would be in January and February and even up until March 6th. When we saw each other at the PDAC, you know, the pandemic was starting to come, but we didn't realize that that would be the last trip that a lot of people would make for a year. You know, I actually ran off to South Africa and almost got stuck there. I made it back on one of the last flights out of South Africa before they shut down the borders. But I think, you know, obviously economically, socially, politically, financially, things are in much worse shape than we all thought they would be in January. I don't know that this is the beginning of the big one. I think that we back off, but it's really the probabilities are very much balanced that this could be the bigger move up.
Okay, a lot of good information. I know at CPM Group that from time to time you discuss short-term trading ideas. And at the moment, I think a lot of people are quite optimistic. They're strapping in for gold to go higher. So I wanted to ask, what types of buying opportunities can you expect in a market like this where gold is higher than it's ever been? What do you see there?
Well, we like options programs, and you know, we do options strategies for hedgers and for investors. And like, for example, a couple of weeks ago, when the price of gold was only $1,960, we looked at a gold hedge for a producer. We said, okay, you can lock in $1,600 and give up $10 of the upside, and you do that with a compound of options, and you know we price them and stuff, and that's for 12 months. That's a really good deal. So you can lock in a minimum price of 1,600. So if you're an investor and you want to lock in, well, 1,600 is way down compared to where we are right now. But if you look at it, I think the average price from 2010 to 2019 was something like $1,360. So here it's several $100 over the average price of the previous decade, including the rise to record prices in 2011, 2012. That's a very good price, and you're only costing you $10 of the prices above that. I wouldn't necessarily do that if I were an investor. I would be looking at other option strategies to probably buy some puts and pay for them with covered calls or call spreads rather, and possibly buy some calls and pay for them with some put spreads.
Okay. And relatedly, is there a point in time when gold stops being a buy? Does it get too high where you would say, like, no, we shouldn't look at that anymore?
Well, yes and no. It depends on your perspective and your objective. Gold serves investors a lot of purposes. One is a diversifier of one's wealth and one's portfolio and the denomination of one's wealth. So most of us have most of our wealth, if not all of it, denominated in our domestic currency. And by having some gold in your portfolio or gold and silver in your portfolio, you're diversifying the denomination of your wealth, which is very important. And gold as a capital preservation tool is pretty good. There's no such thing as a golden constant. I mean, the price of gold, the purchasing power of gold has fluctuated from 100 to 1,000 over the last 40 years. So it's a very volatile asset. But as a capital preservation tool, one could argue there's no good time not to buy gold, or there's always a good time to buy gold. But with prices up $200 in 2 weeks, 3 weeks, it's probably not the right time. The other thing is capital appreciation. And from a capital appreciation perspective, you have to look at $2,075 and say, from a capital appreciation perspective, my probability scales tell me this is the sell. And if you look at some of the indices, you have seen the ratio of longs in the gold market probably has contracted not quite half over the last 2 or 3 weeks. A lot of people who are these short-term investors that I was talking about earlier, somebody saying, from a momentum perspective, from a technical perspective, from a sheer valuation perspective, gold prices have risen very fast, very far, and it's probably a good time to take profits. Now, again, I love options, so I also like gold both from capital appreciation and capital preservation. So if I'm long gold, and let's say I am, yes I am, and let's say I bought it at $700, or I'm a more recent person, I bought it at $1,700. And I'm worried about the state of the world. I'm worried about U.S. politics, U.S. economics, the dollar, et cetera, et cetera. I can keep my gold and buy a put. Price of gold falls, I have protected myself with a put. I can even, sell it back and make money on it, and I still have that long gold position.
Okay, that's a good explanation. I was watching your latest video, which went up earlier this week, I think. One comment you made is that things are getting very weird economically and politically. I think there's definitely a sense that we're in strange circumstances. And we talk a lot about coronavirus and what's going on with that. But I wondered if there are things you can think of that are being overlooked or not getting the attention that they normally would because of these strange circumstances that we find ourselves in.
Yeah, I think there's several things. And, we've written over the last few years, we've written about the fact that really after 2008, the monetary system changed. And monetary policy and the way central banks handled monetary policy changed dramatically. And that changed a lot of parameters. So, a year ago, 2 years ago, people would say, well, you have an inverted yield curve, and that means that you're going to be in a recession. Because every time from World War II until 2008 that you saw an inverted yield curve, you got into a recession. But that was all history prior to 2008. And things had changed. And the inverted yield curve that we saw in early 2019 didn't reflect the same underlying economic factors that the inverted yield curves did prior to 2008. So you're in a weird economic environment, and a lot of people have been very slow to catch on that monetary policy and financial market operations are radically different now from what they were prior to the global financial crisis. In addition to that, you have further changes that have emerged just in the last 6 months or so, partly because of the global lockdown, the massive increase in U.S. dollars floating around, the move toward Brexit and what that means in terms of financial markets in Europe, the trade war between the United States and China, the trade wars between the United States and Canada, where we have aluminum. We now have an aluminum can shortage in coil stock shortage in the United States, because we've imposed sanctions on Canadian aluminum imports. So there's a lot of weird stuff going on that's really changed the way the system works.
Okay, and you've also written lately about the US dollar, and you made the point that it doesn't actually need to fall in order for gold to rise, which I think is a lot of people do make that connection between the two of them. I wonder if you could explain why that's not the case and shed some light on that idea for people.
Okay, there are like several issues to unbundle here.
Right.
The first one is, should the dollar fall? Are there reasons for the dollar to fall? And the other one is, should gold prices interact with the dollar? Let's deal with the second one first, because we're gold people. The correlation between changes in gold prices, real inflation adjusted changes in gold prices, and real inflation adjusted changes in the dollar exchange rate. The correlation since gold was freed from the dollar in 1968 is about negative 34%. So that means that 66% of the time, gold and the dollar are either moving in the same direction, up or down, or sideways, or they're not moving in any correlated fashion at all. One of them's rising or falling, and the other one's doing nothing. So the relationship between gold and the dollar is a lot different from a lot of people think. Gold does not trade against the dollar. Gold trades against currencies. So you'll find times like in the 1990s when the dollar looked really high, so people were not less interested in it, but the Deutschmark was around, and so they were pouring into the Deutschmark, and gold did nothing. Then the Deutschmark got too high, but people still didn't like the dollar, so they started buying gold. So gold trades against currencies, not the dollar. In addition to that, a lot of times what you'll see is the prices move together because gold and the dollar are reacting to the same independent variables that are off screen. So it could be interest rates, it could be relative economic performance, it could be the flow of dollars into the global economy that is causing people to get concerned about economic stability. So they're buying dollars and they're buying gold because those are the two ultimate safe haven portfolio diversifying assets. So the first or the second part of the question answer is the dollar doesn't need to fall for gold to rise. Mm-hmm. And there's quite often times of economic and political instability where the dollar and gold rise together. So that's the one thing. Then you have to take a deep breath and say, does the dollar have to fall? And one of the points I've made is what a Polish central banker told me in 1981 when they were rescheduling their sovereign debt during that recession. And a Polish central banker said to me, "You don't understand, Mr. Christian. If you owe a bank enough, you own it." And as I said earlier, 62% of foreign exchange reserves at central banks are US dollars. And probably 70 to 80% of private wealth is denominated in dollars. More than half of the pension funds in the world are U.S. pension funds. So the U.S. has printed so many dollars and sent them out into the world that we own it. To be nasty about it. There are so many dollars out there that there is no way that people can say, you're coming up with another $3.7 trillion that you're just printing. I'm getting out of the dollar. Well, you can't. Where are you going to go? You're going to go to the euro? The euro only represents 20% of foreign exchange reserves. So it's 1/3 of the size of the dollar float. In the central bank market. In the private market, it's even smaller. And everybody else is the other 20%. So the liquidity in other currencies doesn't exist. So you say, okay, I'm tied to the dollar. I can hedge it with options. I can hedge it with strategies. And I can use those dollars to do things like buy stocks. Or rather than buy stocks, I'll buy derivatives that are indexed to the stock market. And that's where a lot of that money's been going. So I'm not necessarily as bearish on the dollar as a lot of people are. And when people say, well, they think the dollar is going to zero by the end of the year, that doesn't make sense because it's logistically not it's mathematically, it's not a problem, an equation that can be solved.
So is the dollar, in a sense, is it a safe place to be right now?
We're we're at a place where you don't talk about safe places. You talk about less unsafe places. And the dollar is a less unsafe place than a lot of other currencies right now. Yeah.
We'll go, yeah, okay, thank you. As we wrap up, I want to go back to our PDAC interview. At the time, you said you thought we were in a situation that was similar to the Great Depression, not 2008 financial crisis, as a lot of people were saying at that time. I wondered if you would still make that Great Depression comparison. And if so, what does that say about our path going forward in the situation that we're in right now?
Yeah, I still think that we are closer economically and politically to where we were during the Great Depression than we are to where we were in 2008, 2012. I make a distinction when I say that. There are very many things politically, economically, socially, uh, financially, imbalance of wealth, tensions among the countries of the world, nations and governments of the world. There are many things that are very much more similar to where we were in the early 30s and later 30s, throughout the 30s, than 2008, 2009. But if you look at the magnitude of the problems, we're looking at the IMF, the World Bank, CPM Group, other mainstream economists are saying we might see a 6% decline for the full year in global GDP in developed countries, industrial countries, 4 to 6%. And if you go back to the Great Depression, you were looking at several years with 10, 11, 12, 15% decline. So the order of magnitude is much greater. We have something like 20% unemployment in the United States now. We had 40% unemployment back then. We didn't have a social security system. We had none of the social net safety nets that we have now. So order of magnitude is great difference. We saw the second quarter GDP figures came out. It was negative 32.9. And people said, my God, that's the biggest quarterly drop in real GDP on a quarterly basis in history. You say, well, what happened during the Depression? Oh, well, we didn't have quarterly data in the 30s. We only started reporting quarterly data in 1947. So we have no idea. There are a few people whose judgment I wouldn't trust about anything. And they say, well, we've calculated what quarterly GDP was during the Depression, but those numbers are nonsensical. So if you look at where we are, we're very similar to where we were in the 30s in many ways, in many frightening ways. But the order of magnitude is not where we were there. And that goes back to where we were starting this conversation, where I was saying we think we're in the foothills and there's a bigger financial and economic and political crisis that's going to come in 3 or 4 years from now. And we say that predicated on the view of looking at where we are now and saying, yeah, things are bad, but they're going to get worse.
Okay. Well, and on that note, I think we'll wrap it up. Thank you so much for taking the time. I always really appreciate hearing your thoughts.
It's always, I always appreciate somebody listening to me.
Okay. Well, once again, I'm Charlotte McLeod with the Invest in News Network, and this is Jeffrey Christian with CPM Group.